you can figure out what will happen. You can't figure out when it will happen. You don't want to focus too much on when. You want to focus on what. If you're right about what, you don't have to worry about when very much.
What investment mistakes have you made, or that you feel that you made, and how have you used those?
The question is about my business mistakes. How much time do you have? Well, the interesting thing about the mistakes is that in investments, at least for me and for my partner, Charlie Munger, the biggest mistakes have not been mistakes of commission. They've been mistakes of omission. They're where we knew enough about the business to do something, and for one reason or another, we sat there sucking our thumbs instead of doing something. And so we've passed up things where we could have made billions and billions of dollars from things we understood. Forget about things we don't understand. In fact, I could make billions out of Microsoft. Doesn't mean anything because I never understand Microsoft. But if I can make billions out of healthcare stocks, then I should make it, and I didn't. You know, when the Clinton healthcare program was proposed and they all went in the tank, we should have made a ton of money out of that because I could understand it, and I didn't make it. I should have made a ton of money out of Fannie Mae back in the mid-'80s because I understood it and I didn't do it. Those are billion-dollar mistakes or multi-billion-dollar mistakes that generally accepted accounting principles don't pick up. The mistakes you see, we made a, I made a mistake buying U.S. Air Preferred some years ago. I mean, I had a lot of money around. I make mistakes when I get cash. Charlie tells me to go to a bar instead. You know, don't hang around the office. But I hang around the office and I got money in my pocket. I do something dumb. And it happens every time. So I bought this thing. Nobody made me buy it. I now have a 800 number I call every time I think about buying stock in an airline, and they talk me down. They say, you know, I say, well, I'm Warren, I'm an airaholic, and then the guy says, you know, keep talking, don't hang up, you know, and don't do anything rash. And finally, I get over it. But I bought it, you know, and it looked like we were going to lose all our money in that, and we came very close to losing all our money, and you can say we deserved to lose all our money. And we bought it because it was an attractive security, but it was not in an attractive business. I did the same thing with Solomon. I bought an attractive security in a business that I wouldn't have bought the equity in. So you can say that that's one form of mistake, buying something because you like the terms when you don't like the business that well. And I've done that in the past and probably do it again. The bigger mistakes, though, are the ones of omission. I did back when I had the $10,000. I put $2,000 of it into a Sinclair service station, which I lost. So my opportunity cost on that's about $6 billion right now. Fairly big mistake. Yeah, it makes me feel good when Berkshire goes down then because the cost of my Sinclair station goes down too. My 20% opportunity cost. But I will say this: you talk about learning from mistakes. I really believe it's better to learn from other people's mistakes as much as possible. But we don't spend any time looking back at Berkshire. I've got a partner, Charlie Munger. We've been pals for 40 years. We never had an argument. We disagree on things a lot, but we don't have arguments about it, and we never look back. We just figure there's so much to look forward to that there's just no sense thinking about what we might have. It just doesn't make any difference. I mean, you can only live life forward, and you can learn something perhaps from the mistakes, but the big thing to do is stick with the businesses you understand. And so if there's a generic mistake of getting outside of your circle of competence and, you know, buying something because somebody tips you on it or something of the sort in an area you don't know anything about, I mean, you should learn something from that, which is that you stay with what you can figure out yourself. I mean, you really want your decision making to be by looking in the mirror and saying to yourself, I'm buying 100 shares of General Motors at 55 because. And I mean, it's your responsibility if you're buying it, and there's got to be a reason. And if you can't state the reason, you shouldn't buy it. If it's because somebody told you about it at a cocktail party, not good enough. You know, I mean, it's got to be something. You know, it can't be because the volume, you know, the chart looks good on it or anything like that. It's got to be a reason you'd buy the business, and we stick to pretty carefully. That's one of the things Ben Graham taught me. Yeah.
But with the current tenuous economic situation in the world, although our economy seems to be still chugging along quite well, where are we going? What's going to happen with interest rates?
The question about what's going to happen to interest rates or where we go in the world, I don't think about the macro stuff. You know, I just what you really want to do in investments is figure out what's important and knowable. If it's unimportant or unknowable, you forget about it. What you talk about is important, but in my view, it's not knowable. understanding Coca-Cola is knowable, or Wrigley, or Eastman Kodak, or anything. I mean, you can understand those businesses. That's knowable. And whether it turns out to be important depends on where your valuation leads you and the current price and all of that. But we have never either bought a business or not bought a business because of any macro feeling of any kind. We don't read things about predictions about interest rates or business or anything like that because it doesn't make any difference. I mean, let's say in 1972 when we bought See's Candy, I think maybe Nixon put on the price controls a little bit later. Let's say we'd seen that. But so what? We'd have missed a chance to buy something for $25 million that's earning $60 million pre-tax now. I mean, we don't want to pass up the chance to do something intelligent because of some prediction about something that we're no good on it anyway. So we just don't read or listen to or do anything in relation to macro factors at all. Zero. And the typical investment counseling organization goes out and they bring out their economists, they trot them out, and he gives you this big macro picture, and then they start working from there on down. In our view, that's nonsense. And if Alan Greenspan was on one side of me and Bob Rubin on the other side, they were both whispering in my ear exactly what they're going to do the next 12 months. It wouldn't make any difference to me in what I pay for executive jet or general reinsurance or anything else I do. Yeah.
What's the benefit of being an out-of-towner for Wall Street?
Well, what's the benefit of being an out-of-towner as opposed to being in Wall Street? I worked in Wall Street for a couple of years, and I like. I've got my best friends actually, and I'm on both coasts, and I like seeing them, and I get ideas when I go there. But the best way to think about investments is to be in a room with no one else and just think. And if that doesn't work, nothing else is going to work. And the disadvantage of being in any kind of a market-type environment in Wall Street would be the extreme is that you get overstimulated. You think you have to do something every day. I mean, the Canver family paid $2,000 for this company, and you don't have to do much else if you pick one of those. And the trick then is not to do anything else, even not to sell it in 1919, which the family did later on. So what you're looking for is some way to get one good idea a year, and then write it to its full potential. And that's very hard to do in an environment where people are shouting prices back and forth every 5 minutes and shoving reports under your nose and all that. Because Wall Street makes its money on activity. You make your money on inactivity. I mean, if everybody in this room trades their portfolio around every day with every other person, you're all going to end up broke, and the intermediary is going to end up with all the money. On the other hand, if you all own stock in a group of average businesses and just sit here for the next 50 years, you'll end up with a fair amount of money, and your broker will be broke. So his activity he's like a doctor who gets paid on how often he gets you to change pills. I mean, basically. If he gives you one pill and it cures you the rest of your life, he's got one sale, one transaction, and that's it. But if he can convince you that changing pills every day is the way to great health, it'll be great for him and the prescriptionists, and you'll be out a lot of money, and you won't be any healthier. You'll be a lot worse off financially. So you want to stay away from any environment that stimulates activity, and Wall Street would have the effect of doing that. I used when I went out to Omaha, I'd go back about once every 6 months, and I'd go back with a whole list of things I wanted to check out one way or another, companies I wanted to see, and I would get my money's worth out of those trips. But then I'd go back to Omaha and think about it. Yeah.
How should an investor evaluate owning shares of Berkshire Hathaway or Microsoft when they don't pay dividends to the investor?
Yeah, well, the question with Berkshire Hathaway, the question was about evaluating Berkshire when it doesn't pay any dividends, and it won't pay any dividends either. It's a promise I can keep. All you get with Berkshire, you stick it in your safe deposit box, and then every year you go down and fondle it. You take it out and you fondle it, then you put it back. And I mean, there's enormous psychic reward in that. You don't underestimate it. But the real question is whether we can keep retaining dollar bills and turning them into more than a dollar at a decent rate. And that's what we try to do. And Charlie Munger and I have our money in it to do that. That's all we'll get paid for doing. We won't take any options. We won't take any salaries to speak of or anything. We'll ride around in the plane. But that's what we're trying to do. It gets harder all the time. The more money we manage, the harder it is to do that. And we would do way better percentage-wise with Berkshire if it was 1/100th the present size. But it is run for its owners, but it isn't run to give them dividends, because so far, every dollar that we've earned and could have paid out, we've turned into more than $1. It's worth more than $1 to keep it. And therefore, it'd be silly to pay it out. Even if everybody was tax-free that owned it, it would have been a mistake to pay dividends at Berkshire, because so far the dollar bills retained have turned into more than $1. But there's no guarantee that that happens in the future, and at some point the game runs out on that. But it is the goal of, I mean, that is what the business is about. We're not, nothing else about the business do we judge ourselves by. We don't judge it by the size of its home office building or, you know, anything of the number of people working around it. We've got 12 people at headquarters. We've got 45,000 employees at Berkshire and 12 people at headquarters, 3,500 square feet. And we won't change it. So we will judge ourselves by the performance of the company. And that's the only way we'll get paid. But believe me, it's a lot harder than it used to be.
One of your investments has reached its full potential. As you said earlier that you...
I missed the last part of it. Oh, reach its full potential. Well, ideally you buy in businesses where you feel that will never happen in terms of... I mean, I don't buy Coke with the idea that it's going to be out of gas in 10 years, you know, or 15 years. I mean, there could be something happen, but I would think the chances of that are almost nil. So what we really want to do is buy businesses that we would be happy to own forever. It's the same way I feel about people who buy Berkshire. I want people to buy Berkshire that plan to hold it forever. They may not for one reason or another, but I want them at the time they buy it to think they are buying a business that they're going to own forever. And I don't say that's the only way to buy things. It's just that that's the group I want to have join me, because I don't want to have a changing group all the time. I measure Berkshire by how little activity there is in it. If I had a church and I was the preacher and half the congregation left every Sunday, I wouldn't say, oh, this is marvelous because I have all this liquidity among my members, you know. You know, there's terrific turnover, you know. I would rather get a church where all the seats are filled, you know, every Sunday by the same people. Well, that's the way we look at the businesses we buy. We want to buy something that we're really happy to own virtually forever, and we can't find a lot of those. And back when I started, I had way more ideas than money, so I was just constantly having to sell what I thought was the least attractive stock in order to buy something that I just discovered that looked even cheaper. But that's not our problem really now. And so we hope we're buying businesses that we're just as happy with 5 years from now as now. And if we ever found some huge acquisition, you know, then we'd have to sell something maybe to make that acquisition. But that would be a very pleasant problem to have. We never buy something with a price target in mind. I mean, we never buy something at 30 saying if it goes to 40 we'll sell it, or 50 or 60 or 100. We just don't do it that way any more than when we buy a private business like See's Candy for $25 million. We don't say to ourselves, if we ever get an offer of $50 million for this business, we'd sell it. That's just not the way to look at a business. The way to look at a business is this going to keep producing more and more and more money over time? And if the answer to that is yes, you don't need to ask any more questions.
How did you come up with the valuation?
Well, Solomon, like I said, I went into that because it was a 9% security in 1987, September 1987. The Dow was up 35% that year. We'd sold a lot of stuff, and I had a lot of money around. It looked to me like we were never going to get a chance to do anything. So I took an attractive security form in a business I would never buy the common stock of. And I went in because of that, and I think that's generally a mistake. It worked out okay finally on that, but it's not what I should have been doing. I either should have waited, in which case I could have bought more Coca-Cola a year later or thereabouts, or I should have even bought Coke at the prices it was selling at then, even though it was selling at a pretty good price at the time. So that was a mistake. On long-term capital, we have learned other businesses that are associated with securities over the years. And, I mean, one of them is arbitrage. I've done arbitrage for 45 years, and Graham did it for probably 30 years before that. And that's a business, unfortunately, I have to be near a phone for, and I have to really run out of the office myself, because it requires being more sort of market attuned, and I don't want to do that anymore. So unless a really big arbitrage situation came along that I understood, I won't be doing much of that. But I've probably been in 300 arbitrage situations at least in my life, maybe more. And it was a good business, perfectly good business. Long-term capital has a bunch of positions. They got tons of positions, but the top 10 are probably 90% of the money that's at risk. And I know something about those 10 positions. There's a few other positions we have that aren't that big because they can't get that big, but they could involve yield curve relationships or on the run, off the run governments or things like that are just things you learn over time if you're around securities markets. They're not the base of our business. Probably on average, they've accounted for a 0.5 percentage point of our return a year, or 0.75 of a percentage point a year of our return. They're little pluses that you get for actually having just been around a long time and learning a little bit about it. First arbitrage, not the first arbitrage I did, but one of the first arbitrages I did, involved a company where they were offering cocoa beans in exchange for their stock. That was in 1955. And I bought the stock, turned in the stock, got warehouse certificates for cocoa beans, and they happened to be a different type that were traded in the New York Cocoa Exchange, but there was a basis differential in my favor, and I sold them. I mean, that's just something that I was around at the time, so I learned about. Hasn't been a cocoa bean deal since. 40-odd years. I've been waiting for another cocoa bean deal. I haven't seen it, but it's there in my memory if it ever comes along. And that long-term capital is that on a big scale. Yep. The question is about diversification, and I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs. Because all they're going to do is own a part of America. And they made a decision that owning a part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it, unless they want to bring an intensity to the game to make a decision and start evaluating businesses. But once you're in the business of evaluating businesses and you decide that you're going to bring the effort and intensity and time involved to get that job done, then I think that diversification is a terrible mistake to any degree. And I got asked that question when I was at SunTrust the other day. And if you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need. And you're going to make a lot of money. And I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea. But a lot of people have gotten rich on their best idea. So I would say that for anybody working with normal capital who really knows the businesses they've gone into, 6 is plenty. And I probably have half of it in what I liked best. I don't diversify personally. I mean, and all the people I know that have done well, with the exception, well, we mentioned Walter Schloss here earlier. Walter diversifies a lot. He owns a little of everything. I call him Noah. He's got 2 of everything. Yeah.
How do you differentiate the Coca-Colas of the world from the Procter & Gamble's of the world?
Well, Procter & Gamble's a very, very good business. Strong distribution capabilities, lots of brand names and everything. But if you ask me, if we're going to go away for 20 years, to put all my family's net worth in one business, would I rather have Procter & Gamble or Coke? Actually, Procter & Gamble's a little more, it'd be more diversified among product line, but I would feel sure of Coke than Procter & Gamble. I wouldn't be unhappy if somebody told me I had to own Procter & Gamble during that 20-year period. I mean, that would be in my top 5% because they are not going to get killed. But I would feel better about the unit growth and the pricing power of a Coke over 20 or 30 years than I would about a Procter & Gamble. Right now, the pricing power might be tough, but you think of a billion servings a day, an extra penny, $10 million a day, We own 8% of it. That's $800,000 a day for Berkshire Hathaway. You get another penny out of the stuff. Doesn't seem impossible, does it? I mean, it's worth another penny. It doesn't. Right now, it'd be a mistake to try and get it in most markets. But over time, Coke will make more per serving than it does now. 20 years from now, I'll guarantee it'll make more per serving. They'll be selling a whole lot more servings. I don't know how many. I don't know how much more, but I know that. P&G's main products, I don't think they have the kind of dominance. And they don't have the kind of unit growth, but they're good businesses. I would not be unhappy if you told me that I had to put my family's net worth in P&G and that was the only stock I could own. I would, I might prefer some other names, but there aren't 100 other names I would prefer. Yeah.
On that same model, what about McDonald's? Should we go away 20 years, come back?
McDonald's, the question's about McDonald's and going away for 20 years. McDonald's has got a lot of things going for it, and particularly abroad again. I mean, their position abroad in many countries is stronger relatively than here. It's a tougher business over time. People do not want to eat, exception to the kids when they're giving away Beanie Babies or something, people do not want to eat at McDonald's every day. I mean, if people are drinking Coke today, they drink 5 of them today, they'll probably drink 5 tomorrow. The fast food business is tougher than that. But if you had to pick one hand to have in the fast food business, which is going to be a huge business worldwide, you'd pick McDonald's. I mean, it has the strongest position. It doesn't win taste tests, with adults. I mean, it does very well with children, and it does fine with adults. But it is not like it's a clear winner. And it's gotten into the game in recent years of being more price promotional, and you remember the experiment a year ago or so, and so it's gotten more dependent on that rather than just selling the product by itself. I like the product by itself sells. I feel better about Gillette if people buy the Mach 3 because they like the Mach 3 than if they get a Beanie Baby with it. So I just think it's fundamentally a stronger product if that's the case, and it probably is. We own a lot of Gillette, and you can sleep pretty well at night if you think of a couple billion men with their hair growing on their faces. You go to, it's growing all night while you sleep, and women have 2 legs. I mean, it's even better. So it beats counting sheep. And those are the kind of business. But if you think, what promotion am I going to put out there against Burger King next month? And what if they sign up Disney and I don't get Disney? And I mean, that is, I like the products that stand alone, absent promotional or price appeals. Although you can build a very good business based on that, and McDonald's is a terrific business. It's not as good a business as Coke, but there really are hardly any. It's a very good business, and if you bet on one company in that field, aside from Dairy Queen, of course, you want to bet on McDonald's. We bought Dairy Queen here a while back. That's why I'm plugging it shamelessly here. Yeah, way back there. What do I think of what? The electric utility industry. Well, I've thought about that a lot because you can put big money in it, and I've even thought of buying entire businesses. There's a fellow in Omaha actually that's done a little of that through Cal Energy, but I don't quite understand the game in terms of how it's going to develop with deregulation. I mean, I can see how it destroys a lot of value for the high-cost producer, once they're not protected by a monopoly territory. And I don't for sure see who benefits and how much. I mean, obviously the guy with very low-cost power, some guy's got hydropower, at 2 cents a kilowatt or something like that, has got a huge advantage. But how much of that he's going to get to keep and everything, or how extensively he can send that outside his natural territory, I haven't been able to figure that out so that I really think I know what the industry is going to look like in 10 years. But it is something I think about, and if I ever develop any insights, that call for action, I'll develop, I will act on them. Because I think I can understand the attractiveness of the product, and it's all of that, all of the aspects of certainty, of user need, and the fact that it's a bargain and all of that. I understand. I just don't understand who's going to make the money in it 10 years from now, and that keeps me away. Yeah.
Do you think that the market has favored the large cap blue chip stocks over the small cap stocks over the next couple of years?
The question is large caps versus small caps, and why have large caps overperform. I don't know the answer to that. We don't think we don't care whether companies large cap, giant cap, middle cap, small cap, micro cap. It doesn't make any difference. I mean, the only question to us is, can we understand the business? Do we like the people running it? And does it sell for a price that is attractive? From my personal standpoint, running Berkshire now, because we've got pro forma for Gen Re, I don't know what we have, maybe 75 or 80 billion dollars to invest, and I only want to invest in about 5 things. So I'm really limited to very big companies. But if I were investing $100,000, I wouldn't care whether something was large cap or small cap or anything. I would just look for businesses I understood. Now, I think that on balance, large cap companies as businesses, have done extraordinarily well the last 10 years and way better than people anticipated they would do. I mean, you really have American business earning close to 20% on equity, and that's something nobody dreamed of, and that's being produced by very large companies in aggregate. So you've had this huge revaluation upward because of lower interest rates, and then much higher returns on capital. And you know, if American business is really a bond, disguised bond that earns 20%, has a 20% coupon, it's much better than if it's a bond with a 13% coupon. And that's happened with big companies in recent years. Whether it's permanent or not is another question. I'm skeptical of that, but I don't. I wouldn't even think about, except for questions of how much money we run, I wouldn't even think about the size of the business. A good small See's Candy was a $25 million business when we bought it. I mean, if I could find one just like it now, even as big as we are, you know, I'd love to buy it. It's the certainty of it that counts. Yeah, way over there.
You mentioned earlier that in buying stock, almost every company is public. And one thing until the last 5 years, real estate has been primarily private. We're now seeing a great securitization of real estate. And what is your insights into the industry?
Yeah, you're talking about real estate equity. There's been securitization, enormous securitization of the debt, too, of real estate. And that is one of the items right now that is really clogging up the capital markets. I mean, the mortgage-backed securities they're just not moving in commercial mortgage-backed, not residential mortgage-backed, and so that's. But I think you're directing your question at equities probably, and the equities. If you leave out, the corporate form has been a lousy way to own equities. I mean, you've interjected a corporate income tax into something that people individually have been able to own with a single tax, and by having the normal corporate form, you get a double taxation in there you really don't need with real estate, and it takes away too much of the return. REITs have, in effect, created a conduit so that you don't get the double taxation, but they also generally have fairly high operating expenses. And if you get real estate, let's just say you can buy fairly simple types of real estate on an 8% yield or thereabouts, and you take away maybe close to 1 or 1, maybe even 1.5% by the time you count stock options and everything. It's not a terribly attractive way to own it. Maybe the only way a guy with $1,000 or $5,000 can own it. But if you have $1 million or $10 million, you're better off owning the real estate properties yourself and sticking some intermediary in between that will get a sizable piece of the return for himself. So, but generally speaking, we've seen very, very little in that field that gets us excited. People sometimes get very, very confused about. They'll look at some huge land company. I'll take one that won't evoke any emotional reactions on the part of anybody, like Texas Pacific Land Trust, which has been around over 100 years and got a couple million acres in Texas. And they'll take they'll sell 1% of their land every year, and they'll take that as applying to everything and come up with some huge value compared to the market value. But that's nonsense if you really own the property. I mean, you can't move. You can't move 50% of the properties or 20% of the properties. It's way worse than an illiquid stock. So you get these. I think you get some very silly valuations placed on a lot of real estate companies by people that don't really understand what it's like to own one and try to move large quantities of property. REITs have behaved terribly in the market this year, as you know, and it's not at all inconceivable they would become a class that would get so unpopular that they would sell at significant discounts from what you could sell the properties for. And they could get interesting as a class then, and then the question is whether the management would fight you in that process, because they would be giving up their income stream for managing things, and their interests might run counter to the shareholders on that. I've always wondered about the REITs that say, our assets are so wonderful and they're so cheap, and then they go out and sell stock. I mean, there's a contradiction in that. If they say our stock at 28 is very cheap, and then they sell a lot of stock at 28 less an underwriting commission, it doesn't. There's a disconnect there, and so. But it's a field we look at. I mean, Charlie and I can understand real estate, and we would be open for very big transactions periodically. And if there was a long-term capital management situation and translated to real estate, we would be open to that. The trouble is so many other people would be too, that it would be unlikely to go at a price that would really get us excited. Way back there.
Understanding your theory that sort of a down market is good for net savers, can you sort of give us your thoughts as to where the market's going, its downward trend, and long-term drops and the long-term drops?
Well, yeah, I've got no idea where the market's going to go. I prefer it going down, but I haven't. My preferences have nothing to do with it. The market knows nothing about my feelings. That's one of the first things you have to learn with a stock. You buy 100 shares of General Motors. Now, all of a sudden, you have this feeling about General Motors. I mean, if it goes down, you may be mad at it. You may say, well, if it just go up to what I paid for it, my life will be wonderful again. Or if it goes up, you may say how smart you were and how you and General Motors have this love affair and everything. You've got all these feelings. Stock doesn't know you own it. Stock just sits there. It doesn't care what you paid. It doesn't care that you owned it or anything. So any feeling I have about the market is not reciprocated. I mean, it is the ultimate. It is very cold shoulder we're talking about here. And anybody that is going to be a net saver, practically everybody in this room is more likely to be a net buyer of stocks over the next 10 years than they are a net seller. So every one of you should prefer lower prices. I mean, if you're going to be a net eater of hamburger in the next 10 years, you want hamburger to go down unless you're a cattle producer. And if you're going to be a buyer of Coca-Cola and you don't own Coke stock, you hope the price of Coke goes down. I mean, you're looking for it to be on sale this weekend at your supermarket. You want it to be down on the weekends, not up on the weekends when you're going to attend the supermarket. Your stock exchange is a big supermarket of companies, and you're going to be buying stocks. What do you want to have happen? You want those stocks to go down, way down. And, you will make better buys then. And later on, 20 years from now, 30 years from now, when you're in a period when you're dis-saving or when your heirs dis-save for you, after you're gone, I mean, then you may care about higher prices. But I find people, that was one of the, there's a chapter 8 in Ben Graham's Intelligent Investor about the attitude towards stock market fluctuations. And that and the chapter 20 on the margin of safety are the two most important essays ever written on investing as far as I'm concerned. Because when I read chapter 8, when I was 19, I figured, I just figured out what I just said, but it's obvious. I didn't figure it out myself, though. It was explained to me. I'd probably gone another 100 years if I had read it and still thought it was good when my stocks were going up. No, we want things to go down, but I have no idea what the stock market's going to do. I never do. I never will. It's not something that I think about at all. When it goes down, I look harder at what I might buy that day. Because I know there's more likely to be some merchandise there that I can use my money effectively in.
Okay, Warren, we'll take one more question from the audience.
Okay, I'll let you pick who gets it then. You can be the guy.
What's the question? Okay, right back there. Good. If you live it again, study your life again, then what would you like to do to have a happier life?
Yeah, I would say, and this is going to sound disgusting. The question is, what would I do if I were going to live over again and have a happier life? The only thing I might do is select a gene pool where people live to be 120 or something that I came from. But I've been extraordinarily lucky. I mean, I use this example. I'll take a minute or two because I think it's worth thinking about a little bit. Let's just assume that it was 24 hours before you were born, and a genie came to you, and he said, Herb, you look very promising, and I've got a big problem. I've got to design the world in which you're going to live. And he says, I decided the hell with it. It's too tough. You design it. So you've got 24 hours. You figure out what the social rules should be, the economic rules, the governmental rules, and you're going to live under those, and your kids are going to live under them, and their kids are going to live under. And you say, I can design anything? And Ginny says, yeah, you can do it. And you say, well, there must be a catch. He says, well, there is a catch. You don't know whether you're going to be born black or white, rich or poor, male or female, infirm or able-bodied, bright or retarded. All you know is you're going to take one ball out of a barrel that's got 5.8 billion. You're going to participate in what I call the ovarian lottery. You're going to get one ball out of there. And that is the most important thing that's ever going to happen to you in your life, because that is going to control whether you're born here or in Afghanistan, or whether you're born with an IQ of 130 or an IQ of 70. It's going to determine a whole lot. And you're going to go out of the world and you're going to have that ball. Now, what kind of a world do you want to design? Well, I think that's a good way to look at social questions, because not knowing which ball you're going to get you're going to want a ball that you're going to want a system, design a system that's going to produce lots of goods and services, because you're going to want people on balance to live well. And you're going to want it that produces more and more, so your kids live better than you do and your grandchildren live better than the kids. But you're also going to want a system that, if it does produce lots of goods and services, does not leave behind a person that accidentally got the wrong ball and is not well wired for this particular system. See, I'm ideally wired for the system I fell into here. I mean, I came out and I got something that enables me to allocate capital. You know, nothing so wonderful about that. If all of us were stranded on a desert island, you know, we all landed there and we're never going to get off of it, the most valuable person would be the one that could raise the most rice, you know, over time. And you know, I could say, well, I can allocate capital. You know, how about paying Neil? and you wouldn't get very excited about that. So I am in the right place. I mean, Gates says if I'd been born, you know, a few million years ago, I'd been some animal's lunch. You know, he says you can't run very fast, you can't climb trees, you can't do anything. You've just been, you know, just been chewed up in the first day. So he says you're lucky you were born today, and I am. But the question, getting back, one question you can ask yourself, incidentally, is here is this barrel with 5.8 billion balls. Everybody in the world, if you could put your ball back, and they gave you, and then they took out at random 100 other balls, and you had to pick one of those, would you put your ball back in? Now, those 100 balls that you're going to get out, roughly 5 of them will be American. So there's 95 versus 5. So you're only going to have 5 balls. If you want to be in this country, you're only going to have 5 balls now left. You know, half of them are going to be women, half of them are going to be men. I'll let you all decide how you vote on that one. Half of them are going to be below average intelligence, half are going to be above. I mean, do you want to put your ball back? Most of you, I think, will not want to put that ball back to get 100. So what you're saying is, I'm in the luckiest 1% of the world right now, sitting in this room, top 1% of the world. Well, that's the way I feel. I mean, I've been lucky to be born where I was, because it was 50-1 against me in the United States when I was born. Lucky with parents, lucky with all kinds of things, and then lucky to be wired in a way that in a market economy pays off like crazy for me. Doesn't pay off for somebody who's absolutely as good a citizen as I am, you know, leading Boy Scout troops, teaching Sunday school, whatever, raising fine families, but it just doesn't happen to be wired in the same way I am. So I've been extremely lucky, so I would like to be lucky again. And if I'm lucky, then the way to do it is to play out that game and do something you enjoy, you know, all your life, and be associated with people you like. I only work with people I like. You know, I don't. If I could make $100 million by buying a business with some guy that caused my stomach to churn, I'd say no, because I say that's just like marrying for money, which probably isn't a very good idea in any circumstances. But if you're already rich, it's crazy, right? So I am not going to marry for money. So I would really do almost exactly what I've done, except I don't think I'd have bought the U.S. Air. Thanks.